So are you struggling to grow your stock portfolio over time? Are you perhaps too active and making mistakes on the timing of your purchases? Well, today we're going to meet Terry Smith. Here he is. Terry, Master Fund Manager. Welcome to Finance JCL, everyone. In this video today, I'm going to share with you Terry Smith's 3 key investing rules. He uses these rules in managing his Fundsmith equity fund. 3 rules have made his fund one of the very best performing funds over the last 12 years. I reckon that if we apply his 3 rules to our portfolios, we can also have those incredible returns as well. So let's get straight into it and start with rule number 1. And it's not Warren Buffett's rule 1, don't lose money. Rule 1 here is only invest in good companies. Only invest in good companies. So Terry has his own definition of what a good company is, and Terry defines a good company as one that creates shareholder value by making a high return on capital across the business cycle. Just so we're all on the same page, due to the term return on capital, it is operating profit divided by capital employed, and it's usually discussed as a percentage number. Now, for this theory to hold properly, the return on capital we've just discussed, that figure should be above the company's cost of capital. Kind of a bit like saying if you borrow money at 10% per annum, you invest it and get a 20% per annum return, then you're generating value, forming a high quality operation. But the opposite would be true if you had the 10% cost of capital, so you borrowed money at 10%, but you only got a 5% return on your investment, you'd be destroying value. In the case of a company, destroying shareholder value. Actually, it might be surprising to hear that there are plenty of industries that have this sort of situation. I think one of the key ones is the airline industry. They seem to have very low rates of return on capital. So I want to say it here, from this point forward, I'm not going to buy and own any airline stocks. Although Warren Buffett said something like that once. He said, shoot me if I ever buy airline stocks again. And he actually did right before the pandemic. So anything can happen, really. So just bringing it back. So when you own shares in a good company, a high quality company, its value should increase over time. Effectively, you're sort of betting on a company that's actually already won. Now, the benefit of that also is you can hold them for a long period of time in the right industries. And what that means is there'll be fewer transaction costs and you have to spend less time looking for a replacement because you're holding it for longer. So I thought the best way to summarise Rule 1 is to actually hear from Terry Smith himself. It's Fundsmith 2022 shareholder meeting. We've been applying this approach in this fund since it started in 2010. Here he is with his summary of what a high quality company is, starting with return on capital and a couple of other measures as well that you may find interesting.
Taking you on investment strategy. So how have we done against our 3-pronged investment strategy, which hopefully you're familiar with by now. I'll run you through the usual tables that we give you and a couple of extras this time. There's our look-through ratios. This is where we take our portfolio, work out 5 operating financial ratios for it, and compare what our companies are doing versus the indices out there. And so that's what we've got here. And if you look at it, the return on capital at our companies last year, ROCE in the table, return on capital employed, was 28%, a recovery from the prior year when there was a bit of a downturn caused by the pandemic. This is highly satisfactory insofar as it's back to where it has been in the long term, and you'll see that it's significantly ahead of where the index are, whether it's the S&P or the FTSE. Over there on the right of the table, you see about 14 to 16% return. So to put it in English, for every pound or dollar of capital we own in these companies in our portfolio, we're getting 28 pence or cents of profit return, whereas if you're in the index, you're getting about 15 pence. Our companies are delivering round about twice as much return. And I think that's the single most important metric to look at when you look at our companies performing. Gross margins, these are the difference between revenues and cost of goods sold. Companies take in stuff, they take in ingredients or components or services and do something with them and turn them into products and services that they sell. This is the markup, the difference between the two. Our companies are at 64%, which you'll see is pretty rock solid down the years. basically in English, they're making stuff for 36 and selling it for 100. If you look over at the index, you'll see around 45%. Companies in the index are making things for 55 and they're selling it for 100. Clearly, it's better to make things for 34 and 36 rather than sell it for 100 than it is to make it at 55 and sell it for 100. I mean, one's obviously better than the other. It's also something I think we'll come on to in the questions again, because I'm pretty sure Ian's got a couple for us on the inflationary outlook at the moment. And this, I would suggest to you, is the biggest single defence, first line of defence against inflation of a company, its gross margin. Take out all the other expenses our companies incur, selling, general and administrative expenses, as they call them, SG&A, and you get down to the operating profit margin. You'll see last year, again, a bounce back from the pandemic, 26% against 23% the year before, and it compares with 15 to 17% in the index. Again, very much better than the index. Cash conversion, our companies converted 95% of their profits into cash last year. The index had a particularly good performance. You'll see out there producing somewhere in the region of 108 to 124% of profits in cash. This is a bit of an unusual feature, and the index is performing particularly well at the moment for a couple of rather strange reasons. Bear in mind this is a ratio, and if you make your profits go down more than your cash flow, your cash conversion looks good. It's not a very good place to be, but nonetheless, that's how the ratio comes out. And the reason that's happening is companies in the index, by and large, had bigger falls in profitability than our companies did. And at the same time, because of supply chain difficulties, they had an awful lot of stock out, so their working capital went down invested in the business. So they didn't make as much profit, but they converted more of the profit into cash. I've got a slide to illustrate that in a moment. I think that will reverse as we start to emerge from the pandemic. And lastly, interest cover. So is all this wonderful operating performance that we're getting from our companies being delivered with a lot of borrowed money and balance sheet trickery? No. Our companies last year had 23 times interest cover. So their profits, compared with what they're paying out in interest and lease rentals, was 23 times. I mean, these are very strong balance sheet businesses, basically. You can see they delevered last year at 16 times the year before. The index, not in bad position. If you look, 8 to 9 times interest cover is pretty good, but clearly these are very conservatively financed companies. They're not producing this performance out of financial engineering.
Okay, so that's rule one. Rule number two is try not to overpay. Now, this is distinct from a value investing approach, which will be underpay, i.e. buy with a margin of safety. This is don't overpay. Now, the theory is it's impossible to time the market, and a lot of high quality companies might not be undervalued unless you actually get to a bear market, and they can come every 10 years possibly, and you actually missed out on a lot of return in between those scenarios. With a high quality company, return on capital and the compounding effect, you can actually invest in it when it's reasonably valued, be cheap or undervalued. Make sure you're not overpaying. So I think the best way to describe this is a quote from Charlie Munger, their legendary investor. He says, over the long term, it's hard for a stock to earn a much higher rate of return than the business underlies it earns. Business earns 6% on capital a year over 40 years, and you hold it for that 40 years, you're not going to make much different from that 6% return, even if you originally buy it at a huge discount. Now, conversely, if a business earns, let's say, 18% on capital over 20 or 30 years, even if you pay an expensive looking price to start with, you're going to end up with one hell of a result. Now, of course, that does mean you need to be very careful with your selection of companies in terms of their industry. Is you need to be very clear that that industry will be there in 10 or 20 years' time. So if it's in a sort of highly competitive industry that's got a lot of innovation in it, like the technology sector, these are industries that you can't be sure that a company could still be a leader in that industry in 10 or 20 years' time. Now, you're looking at things perhaps that are a bit more boring, like pet food. That's rule two. So buy good quality companies, don't overpay, but the most important one, arguably, to enable those two rules to actually work is rule number three. And rule number three is do nothing. Rule three, do nothing, is very much the hardest thing for us as individual investors and the hardest thing for fund managers to do. Key is to let that compounding do its work if you've made the right selections in step one and you've bought at the right time in step two. So the great effects, in particular, of reducing transaction. It also avoids that really difficult question of when to actually sell a stock. If you're not actually going to sell it, then you don't need to worry about it. Whereas if you're selling stocks, you need to worry about when the best time is. You may have regret about the time you sold it. But also, if you sell a stock, you're going to find something to buy with that money. It really does save a lot of worry and a lot of time if you do nothing and just hold the stock. Now, that's not to say you shouldn't sell if the situation materially changes. The company's not what you thought it was. Certainly, the aim is not to sell. Now, I suppose, why would you sell if a company's making a 20-25% return on capital using its money well? So, a quick video snippet here for Terry's portfolio turnover, and you see he follows this rule again for his 2022 shareholder meeting. Very low turnover percentages in the portfolio, so he tries his best to do absolutely nothing.
Okay. Do nothing, final leg of the strategy. Here's a table which shows you the T-class shares and what we did last year. You'll see that our portfolio turnover was 5.6%, well within our band for the last few years, nowhere near the highest turnover we've got, and I'm absolutely certain very significantly lower than the average active fund manager out there. You'll see when we come on to talk about the names on the next slide that, as ever, there are more names that we traded than the percentage would suggest, which offers, some people often wonder, well, I wonder how that could be. The answer is very often the things that we sell, because we haven't been adding to them and because they maybe haven't performed all that well sometimes, they drift down as a percentage of our portfolio. So when we sell them, there's not such a big impact on things.
Key learning here for me is I've got a lot of work to do to get to that level of portfolio turnover. And I'd like to get towards that. In terms of measuring his performance, Terry likes to outperform the index. He does compare his performance to the index, but he recognises that it's not possible to outperform in every single reporting period. He writes about this in his book, Investing for Growth. I've got a copy of it. If you'd like to have a copy to read about all his rules and his concepts, there's a link directly in the description below where you can buy that through Amazon. But if you want the video version, get a summary of this, there's a great video that's coming on the screen now. And this video will tell you about Tour de France, one of the themes in Terry Smith's